Okay, so welcome to the deep dive. Today, we're going to tackle kind of a big one, the
Mhm.
big economic story that's developing. And that's this whole thing with the Bank of Canada and what they're likely going to do with interest rates. We've got all kinds of stuff to dig into, reports and analysis, the whole nine yards. But I think what we're really hoping to understand is like, what are the main reasons behind this rate cut that everyone seems to be expecting, especially, with all this trade tension with the U.S. kind of looming over everything?
Yeah, no, exactly. I mean, it really is such a fascinating moment. You've got like these internal signals from the Canadian economy kind of pointing in one direction. And then you've got these huge external factors, with trade. And it's like this balancing act that the Bank of Canada has to figure out right.
For sure. Okay, so let's get right into it. The big day everyone's talking about is Wednesday, and the word on the street is that the Bank of Canada is probably going to lower its key interest rate by a quarter of a percentage point. So that would bring the policy rate down to 2.75%.
Okay.
I mean, the really interesting thing here is that if this happens, this would be the seventh cut in a row. We're sitting at 3% right now, and I know a lot of our sources are saying this is still high if you look at the bank's kind of ideal range, that 2.25 to 3.25% window.
Yeah, and that's what makes this whole thing so interesting, right? Like, what's the strategy here? Is the bank kind of trying to steer things back towards the middle of that neutral range? Like Jeremy Kronik over at the C.D. Howe Institute, he makes a really compelling argument that, this could be a way for the bank to kind of signal, like, hey, we're here, we're ready to support the economy if things get rocky. It's almost like a reassurance to everyone,
Yeah.
businesses, consumers, like, we're paying attention, we got your back.
Right. It sends a message for sure. Now, going back to what Governor Macklem said back in January, he was talking about this delicate balance. Tariffs could slow things down, but also could push inflation up. It sounds like even if we just focus on what's happening in Canada, the economic data has been a little all over the place, right?
Oh, yeah, totally. I mean, take Canada's GDP growth last quarter, the last quarter of 2024, it came in strong, really strong, actually, a 2.6% annualized rate. That's a really good sign, right? Like the economy's got some underlying strength. But then on the other hand, we saw a core CPI inflation tick up in January. So that's suggesting, maybe some underlying inflation is sticking around. So yeah, if we just looked at Canada on its own, maybe a rate cut right now wouldn't be the most obvious move.
But then February's jobs report came out,
Hmm.
and that seemed to kind of change the whole conversation. Only 1,100 jobs added. I mean, that's pretty weak. And it feels like that one report really shifted the market's expectations for a March rate cut. I mean, it jumped to over 80%. Even though the unemployment rate stayed put at 6.6%, that lack of job creation, it really seemed to set off alarm bells.
Absolutely. And I think this points to a potential shift in the thinking behind this whole easing of monetary policy. Like economists over at the National Bank of Canada, they're suggesting that maybe the previous rate cuts were more about dealing with existing slack in the economy, right? Areas where we weren't operating at full capacity. But now it seems like the focus is shifting more towards like proactively trying to protect the economy from, potential fallout of a trade war.
Which brings us to, the elephant in the room, the whole trade situation with the U.S. Things are changing so fast. But right now, it looks like President Trump has announced a one-month delay on those big 25% tariffs that were supposed to hit Canadian goods that fall under CUSMA, the Canada-United States-Mexico agreement. It's important to keep in mind that this covers a huge chunk of our exports, like almost 40%.
But like you said, that relief could be really short-lived. I mean, at the same time, the U.S. is still planning to slap a 25% tariff on Canadian steel and aluminum exports. And get this, that's supposed to go into effect this Wednesday, the same day as the Bank of Canada's rate decision. Like, you can't ignore that timing. And looking even further down the road, we're probably looking at retaliatory tariffs from the U.S. maybe as early as April 2nd. And those could hit some pretty key Canadian industries, dairy, lumber. Those are huge sectors in certain parts of Canada. So these very specific tariffs, they could really hammer specific communities and businesses way more than, like a broad tariff would.
Yeah, so we're potentially looking at some really serious disruptions to our trade. And the Bank of Canada, they've actually done some modeling, trying to figure out what a full-blown trade war with the U.S. would look like for our economy. And the numbers they've come up with are pretty scary. They're projecting a 12% drop in Canadian investment and an 8.5% decrease in our exports.
Yeah.
And that's just in the first year. I mean, wow.
It's huge. And if you think about the bigger picture, the Bank of Canada is estimating that a trade war like that could actually shave off something like 3% of Canada's GDP over the next 2 years. Just to put that in perspective, that's a massive hit, like on par with some of the major economic slowdowns we've seen in the past. I mean, it really shows you how serious this whole situation could become.
Absolutely. And like Jeremy Cronick pointed out, trying to predict what's going to happen with the economy is always tough, right?
Yeah.
But when you throw in all this unpredictable stuff with international trade, it becomes almost impossible.
Yep.
Central bankers are basically trying to plan in the dark.
And that brings up a really important point about what monetary policy can actually do. Governor Macklem, he's been very clear that adjusting interest rates, it can't completely offset the kind of damage that a big trade war could do. That's where fiscal policy, government spending and taxation, that's where it becomes crucial.
Right. So the thinking is that we might see some targeted financial help coming from both the federal and provincial governments, specifically to help out workers and businesses that are going to be directly impacted by these tariffs. And in that context, the Bank of Canada's rate cut, it would be more about providing a kind of general support to help the whole economy adapt to all this.
Exactly. And the economists over at the Royal Bank of Canada, they've been pointing out that fiscal policy has a big advantage here. You can really fine-tune it to specific industries or regions, and it can usually be implemented a lot faster than interest rate changes, which tend to have broader and slower effects. They also make a good point that even after this expected rate cut, interest rates are still at a level that suggests the bank has some wiggle room. They could respond again if things get worse.
So basically, it sounds like this interest rate cut that everyone's expecting isn't really because the Canadian economy is fundamentally weak right now. I mean, the recent jobs numbers are definitely a bit of a worry, but the main reason seems to be that the bank is trying to get ahead of the curve. Try to soften the blow from all this trade uncertainty with the U.S. It's like they're walking a tightrope, right? Trying to give the economy some support, but not overreact to a situation that's still, totally up in the air.
Yeah, it's really wild to see how closely tied our domestic economic policy is to these international trade dynamics. It really shows you how complex it is to manage a smaller, open economy like Canada's in this crazy global environment.
Absolutely. Well, on that note, here's something for everyone to think about. Given how limited monetary policy can be when it comes to dealing with major disruptions to global trade, what do you think are the most effective and sustainable ways for governments to step in and provide really targeted help and build resilience in those sectors that are going to be the most exposed to these kinds of trade conflicts? It's a comment that goes beyond just interest rates. It forces us to think about the big picture, economic strategy, and how we prepare for the future. Anyway, thanks for joining us for this deep dive.
Absolutely. Always a pleasure.
Until next time. See you.